So without taking further time on introduction, I will just get on to the topic. So if we can move to the next slide, Varun. So the way this webinar is structured is that first we delve into the background of LIBOR. What is the basis on which LIBOR is derived? What are the moot problems with LIBOR, given that it is an estimation-based interest rate? And we will then move on to discuss what were the circumstances or factors which led to the fall of LIBOR, the distrust that we started seeing with LIBOR and the move away from it. What were the causes which led to that? And eventually, when the agencies realized that we cannot have LIBOR anymore, they one by one started spelling out LIBOR cessation timelines. So in lieu of LIBOR today now, we are having alternative reference rates so that people can continue with their financial transactions in a streamlined manner. All this has a lot of implications for not just transfer pricing, but even third-party financial transactions. LIBOR until recently has been the bedrock of financial transactions for close to $1 trillion economy or volume of financial transactions. And suddenly, as we replace LIBOR with alternative reference rates, issues are bound to arise. So we will look at what are these issues and what are the risk mitigation steps that companies can take to overcome these issues when we will discuss the transfer pricing implications and the way forward. So let's move on to briefly discuss the background of LIBOR. So LIBOR is just an acronym for the London Interbank Offer Rate. So this is a benchmark reference rate wherein the London central bank would lend to the other banks. And this interest rate was derived not on the basis of actual transactions that have happened in the previous day or the previous week, but on the basis of an estimate. So in that sense, it was forward-looking. My colleague Varun will dive deeper on the conceptual aspects of LIBOR and what were the issues which arose with LIBOR, which gradually led to its replacement. With this brief background, Varun, I will leave it to you to delve deeply into its concept, and also the drawbacks which led to manipulation of LIBOR and its replacement. Please, over to you, Varun.
Sure. Many thanks, Ashutosh. So, hi everyone. So as Ashutosh has already briefed, so what exactly LIBOR is. So starting from the basics, right? What exactly LIBOR was, how it came into existence, how it is calculated. So LIBOR, as the term suggested, so it's a London interbank offer rate. So it's the rate of interest at which banks lend to each other on the London interbank market. Now, this is lent on an unsecured basis. So it's basically a reference rate. If on a simpler term, it acts as a benchmark reference for floating rate transactions and transactions which are not fixed in nature. Additionally, where LIBOR is used is to also set as a reference rate for helping set standards for rate of interest for other financial transactions. It is used to calculate interest rates for various financial instruments, starting be it bonds, derivatives, government and corporate debts, different kind of loans, be it commercial, residential. It also includes to calculate interest rates for some of the consumer products, such as student loans for that matter. Now, if you talk about the existence of this benchmark, LIBOR, so it's more than 40 years old. So it started, so if I may recall, it started in 1969, and it was formalized after almost 2 decades. So more than $400 trillion of transactions today are globally linked on this particular financial transaction or this benchmark. So arguably, one can say that in today's time, it is one of the most important interbank offer rate with regard to the global financial market. It's most widely used for short-term interest rates. So the usage of LIBOR, which is available in different currencies as of date. So it's available in USD, 5 currencies to be precise, in USD, pound, euro, Swiss franc, and yen, and available across different maturity periods. So for all these currencies, it has 7 maturity periods, ranging from overnight to 12 months, which includes an overnight LIBOR, 1 week, 1 month, 2 months, 3 months, 6 months, and 12 months LIBOR. And again, as we've mentioned, it's used for short-term interest rates, calculating short-term interest rates. Now, how is it calculated? Now, it's basically submissions are received from some of the leading international banks so again, international leading banks provide these submissions, and these banks are providing an estimate to the rate of interest which they should be charged or they would charge should they borrow in the London interbank market on an unsecured basis. So practically what is happening is every single day, 18 designated banks, also known as the panel banks, come together. They provide their estimates with the rate of interest which these banks think that they would pay, assumptions which they would pay should they have to borrow funds from other banks, and again on the London interbank market. Now, LIBOR is administered by the Intercontinental Exchange Bank Benchmark Administration. So ICE is the institute which is administering LIBOR. So to cut out the basically to help safeguard against the extreme highs and lows of these estimates provided by these 18 banks, the top 4 and the bottom 4 rates are discarded, and the balance rates which are left, an average is computed by the IC for these balance rates, and this average is the LIBOR which is computed for that applicable date. So every day this transaction is happening, this process is happening, estimates provided by these banks, and an average is determined to be the LIBOR for that particular day. Now, one important thing to be noted here is, now in this entire discussion, LIBOR is based on estimates. This methodology is purely based on estimates, what these banks think they would charge, and not on the actual transactions. Now, why this is important is because this entire methodology is the premise on basis which the fall of LIBOR started, which we'll take a look in the other subsequent slides. Now, there are 2 prime reasons, to be precise, if we talk about that, what led to the LIBOR reforms and what led to the fall of LIBOR. 2008 global financial crisis. So it led to a reduction of a lot of, there was a subsequent reduction in the volume of transactions which were based on the intercompany, which were based on the London interbank market. So due to this significant reduction in the volume of transactions, and this is and these are the volume of transactions on the basis of which LIBOR was based. There was a huge amount of reliance given on these estimates, which were provided by these panel banks. Now, the regulatory bodies, the IC and the other regulatory bodies governing LIBOR, raised concerns. They started having questions regarding the sustainability and the viability of this LIBOR on a long-term basis, considering the reduction and consistent reduction in the volume of transactions happening on the interbank lending market. So this was one of the reasons, again, starting from 2008. So one view is that 2012 was the year in which the fall of LIBOR actually started, but this dates back to 2008, and a saying is also, so one view is also said that one of the reasons for the financial crisis was also because of the manipulations which were happening in the LIBOR reforms, and which were uncovered in 2012. Now, in 2012, the second and most reason for the fall of LIBOR was the scandal which broke out in 2010, a huge setback, a shock to the financial market globally. So what was happening is, as we've already discussed, LIBOR, how LIBOR was computed was based on these estimates provided by these panel banks, these designated panel banks, and these panel banks were leading banks, right? So these panel banks, and some of these panel banks, were manipulating these rate of interest for their internal benefits. These were rigging the rate of interest. So a detailed investigation occurred in 2012, out of which, so this entire scandal was uncovered. Leading banks names including Barclays, Dutch Bank, UBS, Royal Bank of Scotland. These were some of the leading names which came in front. In fact, Barclays was one of the leading players, one of the key players in this complicated scam. So played a very major role. What practically was happening is, one example is that Barclays, for example, was claiming that the rate of interest charged by it or claimed by it while providing the estimates for LIBOR was lower than the rate of interest with respect to the other banks.
Yeah, Varun, I think suffice to say that there was some manipulation happening and rigging in the interest rate, right? Which was uncovered, and which is why the trust on LIBOR was shaken. And of course, the first blow was the financial crisis of 2008, followed in 2012 by this uncovering of the manipulation. So from here on, let's just have a look at the subsequent slide on the fall of LIBOR and just quickly go through the timeline, because from a audience point of view, we are really more interested in the consequences of the replacement of LIBOR now with the new rates and how we are going to go about it.
Sure.
So these are just some, please move to the previous. Yes. So these are just few captions from news clippings as to how the media then played out the story of the fall of LIBOR. And as you can see, whatever Varun has just pointed out, all this was there in the news, and it is all documented, what were the names of the banks which were there, and how and why this manipulation happened. There's a lot of literature available. Suffice to say that there was an issue with LIBOR. It was amenable to manipulation, which is why the financial world felt the need to replace it with a more reliable measure. Varun, move to the next slide, please. Yes. Yeah. So now, eventually then, the agencies set out timelines for transition from LIBOR to a new regime. So Varun, I leave it to you now, if you can just go through the regime. And very important is the synthetic version also of LIBOR. Yes.
Correct. Correct. So it was in 2017, now that the scandal broke up, the work committees were set up. Now, what should be the next process? What should be the next step? So FCA, the Financial Conduct Authority, which was administering this benchmark. So on March 2021, it came up with an announcement that LIBOR shall cease to exist. So in fact, in 2017, this announcement, there's a typo over here, 2017, the FCA came up with an announcement that going forward from 2021, the LIBOR shall cease to discontinue across this different settings. In 2021 March, it came up with the detailed timelines with respect to which each of these different settings shall cease to exist. Now, immediately after 31st of December 2021, LIBOR settings with regard to Euro, Pound, Swiss franc, Yen, and 1 week and 2 months of USD LIBOR would cease to exist from that particular date. For the remaining balance, for the remaining LIBOR settings, which is the USD LIBOR settings for the remaining securities, remaining maturities, 30th June 2023 was considered to be the deadline. And this was in line, a grace period was given to USD LIBOR, keeping in mind the amount of volume of transactions which are happening on USD LIBOR. So huge amount of transactions happening on this particular benchmark. So therefore, a grace period was given. So now, today, as of date, when we're discussing this this topic, so LIBOR, the across settings has been discontinued and ceased to exist. There's an exception to it, a synthetic version of LIBOR, and only for 3 LIBOR settings, which is a 1 month LIBOR, 3 months LIBOR, and 6 months LIBOR, which still stands. So this is a temporary arrangement which the committee has come up with just to make sure that there's a smooth transitioning with respect to some of the important critical LIBOR settings which are happening is until 30th of September 2024. Now, this synthetic version of LIBOR is still available till 30th of September 24. This shall be published by the IC, the benchmark administration, in the same place where the existing LIBORs are published and at the same time as the original USD LIBOR, but will be constituted from the different data. So the data on which so there would be a difference in the data, in the calculation of this data, vis-a-vis how these specific 1 month, 3 months, and 6 months LIBOR would be considered. So being it a temporary arrangement, a stopgap arrangement, and a grace period. Now, moving on to the next slide. So once this So again, as we are, so the regulatory authorities over this time frame had been coming up with the alternate approaches, the alternate reference rate for each of these LIBOR settings, and they had over time come up with these proposed replacements, which are effective as of today. Now, for USD LIBOR currency, the proposed replacement has been uh, uh, is SOFR, a secured overnight funding rate. And over the slide, you can see the proposed replacement for all the currencies. For pound, it is SONIA, sterling overnight index rate. Euro, Ester, a euro short-term rate has been considered as the proposed replacement. For Swiss franc, SARON, Swiss average overnight rates, and TONAR for the Japanese yen, a Tokyo overnight average rate. So these are the proposed replacement for each of the LIBOR settings across currencies. And
so, Varun, one interesting observation here is that all these replacement rates which are now being proposed, they are based on actual transactions rather than estimate transactions, because already financial agencies having burnt their hands with estimates, they don't want to risk any benchmark being based on estimate transaction, because if you are basing your interest benchmark on an estimate transaction, again, then that becomes amenable to manipulation. So apart from the fact that yes, they continue to be, some of these rates are based on unsecured loan transactions, but they are now placing emphasis that whatever benchmark you take, it must be based on actual transactions and not estimate transactions.
correct. And that's what we've covered in our next slide, basically. So now that these rates have come up, and what Ashutosh has mentioned, these are based on, so this is one of the major difference between the LIBOR and the ARRs. So we've just, over here, we just covered some of the major and key differences between the LIBORs and these alternate reference rates. Now, one basic, so one important, again, which Ashutosh has just covered, is the methodology on the basis of which it is calculated. Now, LIBOR is, as we've discussed, is based on estimates and submissions received from these panel banks. However, these replacement rates, alternate replacement, ARRs, are based on actual transactions happening in the liquid market. With regard to the structure, there's a huge difference. LIBOR was a forward-looking rate, having tenures across different maturities, ranging from overnight to 12 months. However, alternate reference rate is a backward-looking rate. It is based on the overnight rate. So this is one major difference between these two settings. Another major difference is now LIBOR is an unsecured, it's based on an unsecured rate of interest when compared to the alternate reference rates, SOFR, for example. So there's a credit premium involved. There's a risk when calculating the cost of the funds in the LIBOR element. There's a credit premium involved, considering that LIBOR is based on an unsecured basis, unsecured loan, unsecured rate of interest, as compared to the alternate reference rates, which are proxies to risk-free rates and have no credit premium involved. So one view is that a LIBOR would be always greater than the alternate reference rates when computed and when published. The last one, another major difference is the timing of the publication of this particular rate. Now, LIBOR, based on consistent methodology across the 5 currencies, and is published at the same time, vis-a-vis the alternate reference rates, which have different methodologies and different publication timelines for each currency. So again, what we understand from this thing is that there are huge differences between these alternate reference rates and LIBOR, and for obvious reasons that the regulatory authorities wanted to do away with this rigging, which and the manipulation which is happening because of the estimation nature of the reference rate, which was based in LIBOR. Now, so after this, one important concept which needs to be understood is now, and which is important, is how do one come up with the equivalent amount, or how do one mitigate such difference between the LIBOR and the SOFR for the current and existing arrangements which are still active. Now that LIBOR transition is something which has to take place, right? It is immediately in motion. So ISDA, so the International Swaps and Derivative Associations, with this regard, had prescribed a credit spread adjustment. So this is a mechanism, a calculation, a framework based on a mathematical formula, which they had come up with to compute or let go of this difference between the LIBOR and the SOFR. So one such approach followed in the initial years was that they computed the difference between the 5-year historical median between LIBOR and SOFR and compounded the same in arrears. So to compute the respective present value. So this value and this present value was considered to be the spread adjustment which was to and which shall be applied to these alternate reference rates. Now, another important aspect with regard to these spread adjustments, which have to be and which can be considered should be considered while considering this LIBOR transition, is that these are only one time in nature and not dynamic. So once only at the time of LIBOR cessation, when this transition is happening, when a business is undertaking this transition, it has to be computed only at that particular time and not going forward. Bloomberg in July 2019 was assigned with this task by the committees to calculate such spread adjustment based on the framework, based on the methodology prescribed, and to publish these in their respective terminals, and which currently Bloomberg has done. And today, if we go on these databases, along with Bloomberg, there are other commercial databases and tools available, which currently have this spread adjustment in place. And and applying that spread adjustment, one can come up with the equivalent alternate reference rate to be applied with regard to the existing LIBOR arrangement which is happening. This is again regarding the background of LIBOR. In fact, RBI had a different stance on LIBOR. A lot of updates from the RBI perspective have been in place lately. In 2020, the RBI requested the banks to address the risks arising from such cessation of LIBOR, including the preparation of adoption of these ARRs. MIFOR, a benchmark rate for setting prices for forward rate agreements and derivatives, which was derived, which used to derive its reference from the LIBOR, has been discontinued, and an equivalent modified MIFOR has come in place. A comprehensive review of all direct and indirect LIBOR exposures needs to be in place. This is again RBI's instruction to mitigate any such risk arising from such exposures. Banks, FIs are expected to have developed systems and processes to manage this complete transaction. So again, constant updates are coming from the RBIs to make the banks and the businesses aware and make necessary arrangements for the efficient and smooth transition of this LIBOR. Now, again, so the next leg we'll be discussing is the transfer pricing implications. Now that businesses are, now that we've discussed LIBOR, what is the, so again, the fall, the rise, all this. So businesses today are gearing up for this transition. They're already, in fact, taking measures to go away with this LIBOR and have the transition in place. So, but one very important aspect which also the businesses needs to take into account is the implications of the transfer pricing matter or their intercompany transactions or intercompany financial transactions. So as of now, there have been no set guidelines either by the OECD or the Indian tax authorities per se respective to the transfer pricing implications. However, it's expected to come soon, considering the regulations, the current regulations, which consider LIBOR as a benchmark with respect to certain specific categories of transactions, which we'll discuss in the subsequent slides.
Yes, so Varun, here I would just like to add that while we are focusing on the transfer pricing implications, the movement away from LIBOR to alternate reference rates is of course impacting the financial world at large. And there are numerous third-party transactions which will also undergo a change because of the cessation in LIBOR. In these scenarios, as regards third-party transactions, now it is up to the third parties to get back to the table and to find out the credit adjustment spread and how they would want to move from the existing LIBOR rate to the new rate. So there they will have to move forward with bilateral consent, because in the real world between third-party transactions, both parties need to consent to the change. Whether they apply the credit adjustment method or how they will do it, whether they will do a fresh benchmarking, that will be a basis of their negotiation, when they get to the table. In the third party, in the related party scenario, however, This is where the exercise is a little challenging, because you are not going to set the rate based on negotiation, but you will try to simulate the negotiation that will happen in the real world, and therefore you will try to arrive at the equivalent rate in terms of AR for the original LIBOR rate, right? So we will now see as we move forward that what are the factors in terms of documentation, in terms of methodology, the consulting framework, and the challenges that we will there can arise in the transition in a related party scenario. Yes, Varun.
So the foremost challenge, or I would say the most important aspect which one needs to consider, is the existing intercompany agreements, which needs to be evaluated, I would say, immediately. Now, today we are standing in a situation that the intercompany financial the financial transactions are based on LIBOR rates currently. However, they have ceased to exist, so they're no longer in existence. So therefore, companies needs to come up with the alternate reference rate as soon as possible to put it in their intercompany arrangements. Now, one such clause and an important provision which needs to be factored into it, and which is generally not catered into the intercompany agreements, unlike third-party contracts, is a fallback provision or a fallback clause. Now, a fallback clause is basically a legal provision in a contract which, on the trigger of an event, is initiated and it basically applies. It applies post this trigger of an event, the existing arrangements or the existing rates and transaction prices upon the trigger of the event, which shall cease to exist. So again, sorry, reiterating. So fallback provision is a clause or a trigger event on the happening of which the existing rates or the current pricing shall cease to exist. So such a fallback agreement or a clause needs to be incorporated in such intercompany agreements, if not already. Now, a fallback provision would typically include the trigger event, the alternate reference rate, or any other intercompany adjustments or any other comparability adjustments which needs to be done to cater to such LIBOR transition. Now, even after applying such a fallback provision or the transitioning to the other alternate reference rate, now tax authorities, it is important to note that tax authorities can still argue that it is not sufficient to solely renegotiate your base rate, considering this LIBOR transition, because considering the fact that third parties or independent parties might want to also consider other terms and conditions or renegotiate them, considering the risks involved and the functions performed. Now, so one needs to be very wary about these aspects, and again, so considering the risks involved, such fallback clauses and intercompany agreements need to be revisited and renegotiated, if not already. Moving on, another critical aspect related or TP implication is regarding the advanced pricing agreements, the concluded advanced pricing agreements. Now, an APA or these advanced pricing agreements are agreements between a taxpayer and the tax authority, wherein both these parties agree on a future price with regard to the specific international transaction, and which shall be in compliance with the arm's length principle. Now, they come up with a methodology while agreeing with such agreement. They come up with a methodology based on which, and including certain critical assumptions, terms and conditions on the fulfillment of which such an advanced pricing agreement can stay valid for future years as well as past years. Now, this APA, these agreements are valid for future 5 years as well as rollback 4 years. So, transitioning from the LIBOR to the alternate reference rates will be considered to be an important critical assumption for any financial transaction if it is agreed on an advanced pricing agreement. Now, so one has to carefully consider and take necessary actions with regard to such critical assumptions and the way forward. So Rule 10, in fact, Rule 10M of the income tax rules prescribe that In case there is a change in any of these critical assumptions, which includes transitioning of the rate from LIBOR to another alternate reference rate, the agreement can be revised or cancelled, or as the case may be. Further, the assessee which has entered into any such agreement shall give a notice in writing of such change in any critical assumption as soon as it is practicable to do so. So the businesses, again, for concluded APAs, should such an should definitely look at their critical assumptions, whether the same are being adhered to, and appropriate actions need to be taken in terms of intimating the necessary authorities regarding the same. Now, unless an APA already includes a fallback clause, like we've discussed earlier, so cessation of LIBOR may amount to a material change impacting these critical assumptions.
Yes, so Varun, I may just add here. So cessation of LIBOR will impact APAs not only for the loan transactions, but they can also impact for the guarantee transactions, to the extent that intercompany guarantee transactions are also based on some underlying LIBOR-based loan transactions. So I will not get into the nitty-gritty of guarantee benchmarking, but guarantee benchmarking itself sometimes is based on a method called interest saving methods, wherein a differential in interest rates of some loan transactions is taken into account, and the interest rates may in turn be LIBOR derived. So there also cessation of LIBOR will impact the benchmarking of guarantee transaction. So if LIBOR is now coming to an end, this is going to be changed in a critical assumption of the APA. So first thing that the business needs to do is that notify the tax authority that this circumstance is changing. A change in this circumstance is impacting their existing APA, and then the existing APA will have to be revised with the consent of the tax authority. So it is very much possible that in case of financial transactions, that taxpayer and the tax authorities will again have to come back, sit on the table and revisit the mechanism of transition from LIBOR to the alternative reference rate, so that their APA can still carry on. This they will have to do for both loan transactions and also for guarantee transactions, to the extent guarantees are also based on LIBOR-based interest rates. Yes, Varun.
Yep. So moving on, another interesting implication or transfer pricing implication is on the safe harbor rules. Now, income tax rules prescribe certain predetermined arms and price in case of certain specific transactions, international transactions, which shall be accepted by the transfer pricing authorities to be in compliant with the arm's length principle. Now, advancing of intragroup loans, wherein the amount of loan is denominated in a foreign currency, is one such transaction which is included in the safe harbor rules, for which as of now, and which are based on the LIBOR settings as of now. So based on the different credit ratings offered, as you can see on this table, so the safe harbor rules prescribe that a 6 months LIBOR as on the 30th September every year. So and different, again, ranging for different credit ratings to different basis points, shall be accepted by the tax authorities to be in compliant with arm's length principle. Considering the fact that today now we are dealing with a situation where the LIBOR has ceased to exist, and these intercompany income tax rules, these safe harbor rules are still in existence. So a revised safe harbor rules are awaited. And it will be interesting to see what is the government's take, what are the tax authority, CBDT's take on this transition. So as we earlier discussed, the credit spread adjustment, which has to be computed to come up to equivalent, which has to be applied on these alternate reference rate to come up to an equivalent LIBOR. Now, the tax authorities' take on this, the revised safe harbor rules, would be very interesting to again look at. What exactly do they think that how should this spread adjustment be computed? And again, this could definitely act as a benchmark for certain few transactions, or fresh benchmark for fresh proposed transactions going forward.
So actually, the sooner we get to know about the safe harbor rule from the government, the better it would be, because September 30th is, it's not far, and then synthetic LIBOR will also not be there. So we transactions, taxpayers wanting certainty in their transactions with Indian counterparts will definitely like to know what is the safe basis based on SOFR, TONAR, or whatever these alternative reference rates are, so that they can conduct their financial transactions without risk of a tax audit. Given that transfer pricing environment in India is certainly aggressive. So definitely this is something which we expect from the government. Very soon they should come up with some roadmap on how taxpayers should safely transition from LIBOR to the alternative reference rate. Yes, Varun, please go on.
So these are, if to summarize, basically these are the major transfer pricing implications as of now, considering the fact that still there hasn't been any guidelines from the tax authorities in India or the OECD for that matter regarding the transfer pricing implications of the roadmap ahead. So these factors that we have discussed as a considering LIBOR still transition still being at the nation state, something which the businesses should keep in mind. And as a way forward, the recommended step again is for the companies to identify at first their intercompany agreements wherever containing these LIBOR references and modify these agreements. Have proper fallback clauses in place, if not, so that to maintain the robust nature of these intercompany agreements. To the extent LIBOR is referenced in the existing agreements, again, so appropriate fallback language should be included. And again, not just for the related party transactions, as Ashutosh highlighted earlier in the at the start, it's also applicable for all the third party agreements.
Right. So there'll be now going forward, there'll be two scenarios after September 30th. Once LIBOR rates also, synthetic LIBOR also ceases to exist. So one case is where in a related party scenario, companies are undertaking fresh benchmarking. So this fresh benchmarking for loan interest rates or for guarantee interest rates, that will be based on the alternative reference rates. This fresh benchmarking can be undertaken on any publicly available databases like Loan Connect, which provide for these interest benchmarkings. That's one. Or second, in second scenario, what companies can do is that they can make an adjustment to their existing LIBOR rates and convert to the equivalent alternative reference rate, whether based on SOFR, TONAR, or whatever. Now, here there is going to be a catch. The methodology that they are going to use for conversion or transition, that methodology has to be a well-reasoned, fair methodology. Particularly, this is very important on a related party scenario, because whatever methodology they will use, that will be open to challenge by the tax authorities. They will want the full details of that methodology and ask queries on how you have transitioned, whether the new rate is the fair rate given the original rate. So they're all taxpayers, companies, corporates, they need to do this in a methodical manner, refer to the global best practice. Interestingly, we do not have any guidance on LIBOR transition from OECD or from UN. So in that sense, yes, transfer pricing methodology here is in a lurch. We expect government to come up with some guidance on SOFR safe harbor, TONAR safe harbor, or whatever. If that happens, yes, this will give a lot of certainty to taxpayers. But until then, what taxpayers can do is that they use a globally accepted methodology, like the one which Varun has spoken about the credit spread adjustment method, promulgated by a reputed agency. We apply that, and then we switch over to the equivalent rate. You document the entire method based on which you have derived the equivalent rate. So in case the tax authorities demand the justification, then we can present that. So that is the way forward right now. One of the two scenarios. So I believe, Varun, we are done with the substantive aspects of our webinar presentation. And now we can leave the floor open to some questions. There already is a question by Yatin as to what should be the interest rate, arm's length interest rate for a loan by Indian holding company to a UK USA subsidiary for FY 22-23. So Varun, you would like to take this up?
Second.
Yeah, in the chat, so this is for financial year 22-23, and the loan is between an Indian holding company to UK USA subsidiary. So there are, in a way, there are two subparts. One is a pound loan and one is asking for a dollar loan. So of course, see the way, Yatin, that there is no off the cuff answer to a benchmarking interest rate, because sitting here, we can't tell you one uniform rate. Interest rate benchmarking is dependent upon a number of factors. And one very important factor in the interest rate benchmarking is the credit rating of the borrower. Of all the factors for arriving at the arm's length interest rate, credit rating of the borrower, the credit worthiness, financial capacity, standing of the borrower, this is the most critical. So in the factual matrix that you have mentioned, first thing that we will have to analyze to ascertain the arm's length interest rate is what is the credit rating of the UK or the USA subsidiary. That is one thing. And then second issue is that what is the currency, whether it is pound or whether it is dollar currency. And based on that, again, now if we are benchmarking it for future, so we will have to switch to alternative reference rate, and it's going to be a fresh benchmarking. A search shall be run based on a database, applying the different metrics. For example, credit rating of the borrower, the geographical region of the borrower, industry in which the borrower operates. All these factors will be taken account, and then we will arrive at shortlist the comparable transactions. And from there on, the comparable interest rate shall be determined, which shall be able to withstand the test of arm's length scrutiny. So I hope, Yatin, I've answered your question, that this will be the outcome. The answer to your question is basically the answer to a detailed benchmarking exercise. Right.
Yep.
We can.
So we have a question from Stanley Mark. So what is a fallback clause and what is a fallback language? So Stanley, fallback clause is a legal provision in a contract. This is a legal language. Basically, it is to be applied in a case of trigger of an event based on which the existing pricing which is happening shall discontinue. Now, this clause, considering that LIBOR transition, now that LIBOR shall cease to discontinue, so a fallback clause in such a situation should incorporate terms with regard to the trigger event with regard to which this new alternate reference rate shall take place, the names of the alternate base rates to be applied, and necessary adjustments required to the pricing of such transactions from a LIBOR to these alternate reference rates. So again, it's a legal term, it's a legal contract which has to be implemented in the existing agreements so as to make sure that these agreements, the existing agreements, which shall cease to exist again because LIBOR is no longer in continuance, so that they remain robust in nature going forward.
So Stanley, the fallback language in particular, if you would want, you can consult any lawyer for the exact legal language, but the crux of it will be similar to a force majeure clause, wherein on the happening of some event beyond your control, the contract is breached or it comes to an end. In case of LIBOR, the fallback language will be something to the effect that given the fact that LIBOR is ceasing to exist, the parties will have to fall back upon an alternative reference rate arrangement. And in that scenario, parties will again come together and discuss what that arrangement will be like. So this is like an exit clause for them from the current situation to move over to the new situation. I'm just saying this shorn of the legal language, which of course your lawyer or consultant can guide you.
Yep.
Okay. Then another question by Rohan is on the fact that we have given wholly owned subsidiary loan of $7.5 lakhs. Current rate is LIBOR. Please suggest way forward. So yes, for the information of audience, we cannot off the cuff provide answers to exact rates or what is the equivalent rate, because this is all based on a detailed benchmarking econometrics exercise. What we can say is that you will, as Varun explained, you will have to find out the equivalent alternative reference rate based on the credit adjustment spread methodology. And that itself is as Varun gave an example, it's a mathematical equation which has to be applied. One will also have to access the Bloomberg or the other databases which provide the reference rates, and then one will have to arrive at the alternate. Unfortunately, there's no one size fit all answer to every transaction. based on the different factors, the loan agreements, the volume of loan, credit rating, everything, and even the currency one will have to see. Also, one will have to look at what is the currency in which you are transacting. So what will be the alternate? For example, for USD, as Varun mentioned, SOFR is most popular. So we will go with the SOFR alternative reference rate. For yen, tonar will be relied upon. But what will be the premium over the base rate, exact calculation? That is a matter of fact based on a outcome of which can only be known through a benchmarking exercise. So again, Stanley has a question that if the interest rate for a loan transaction is LIBOR plus 2% for a long-term issue in 2019, do you mean the agreement should be modified from 1st of July 2023? So the answer is yes. If the agreement is between related parties, for example, and they do not have any fallback provision already inserted in it, then you need to amend the agreement to take into account that LIBOR is ceasing to exist. So you have to move over from a LIBOR to an alternative reference rate. So yes, you are right. The agreement requires to be modified. So another question from Rohan is, wholly owned subsidiary is in loss since inception, so credit rating will not be good. So yes, Rohan, it is true that there are some subsidiaries or some companies wherein there is loss and credit rating could be very low. In fact, if it is a loss case, then it means it is falling in the speculative grade category. So in the real world, the lending to such companies which are having a speculative grade credit rating or a C grade credit rating is very difficult, and you will not find some benchmarks, loan benchmarks, comparable transactions in for such cases. But if the overall group standing is strong and the credit rating enjoys the brand name of the parent company, there could be some notching up in the credit rating of the subsidiary, and it could, based on the guarantee of the parent company, it could still get that loan. So all these facts will have to be seen. And another fact when it comes to interest rate benchmarking is that what is the purpose for which loan is being given. So because the mechanics between related parties is a little different from the third party lending. Sometimes a parent company in a group may lend to its subsidiary even if the subsidiary is in loss, because subsidiary is ultimately a part of the group company, and it is in the interest of the parent that it must protect the interests of the subsidiary company. This is called shareholder activity, wherein the parent company is reaching out in the interest of the group, overall interest of the group, to extend financial support to a subsidiary. Now, whether or not how much interest rate the parent should charge on the subsidiary, given that it's already in loss, this is a separate question. And again, a lot of factors will be seen. The purpose of the loan. Should it just be giving a interest-free loan to the subsidiary, given that subsidiary is in loss? Well, and would it be tenable before the tax authorities? Maybe, maybe not. Factors have to be seen. How bad is the situation of the subsidiary? There are some case law also, Indian case law including, where interest-free loans have also been justified, given the difficult financial circumstances of the subsidiary. These are cases that are matters of exception rather than norm, but very solid justification has to be built around it, right? So yes, even for a loss-making subsidiary, some kind of benchmarking can be done, but it will be a much more complicated exercise, right? We have more questions coming up, more from Stanley and Rohan, sorry. So Stanley's next question is, since credit rating is of importance, will, for example, SOFR be provided based on different credit rating? Yes, bang on, Stanley. So you've got it very right. The interest rates are dependent upon the credit rating of the company. In fact, the benchmarking exercise which we undertake for interest rate benchmarking, there one of the parameters to shortlist comparables is credit rating itself. So the same way we were going about the benchmarking for LIBOR, and same methodology will be adopted when the alternative reference rates are used. So to answer your question, yes, the value of SOFR will depend upon the credit rating of the borrowing company. Higher the credit rating, lower the interest rate, and vice versa. Right. So any other question? I think we've answered all questions in the Q&A and also in the chat box. this is a little, this is the whole concept of the exercise of benchmarking for financial transactions is a very economics driven technical exercise. We've tried to keep this session simple, broad, and more in terms of the way forward action steps for everyone. But even if everybody today is made aware of the fact that a change like this is imminent, in the next 1 or 2 months, you will not have a very important base rate available. So it's important that you plan around it in terms of documentation, also benchmarking. Those who will do it in a timely fashion will face lesser hardship when scrutiny happens later on. Those who will not make this change right now, they can be challenged by the tax authorities later on. So it's really important. Not only that, they will also struggle to determine the right quantum of cash flows in the form of interest payments, because come September 30th and suddenly your benchmark is not available. So what will you do?